Hello, everyone. Welcome to another episode of Living in the 5280. I'm Najib Alami, your Colorado realtor, and today we have a special guest with us, Brett DeWitt, Vice President of Mortgage Lending at Guaranteed Rate. Welcome, Brett.
Thank you, sir.
It's nice to have you on the show. We're really excited to have you on. Ladies and gentlemen, Brett brings over 21 years of experience in the mortgage industry, and today Brett will be sharing his knowledge on how interest rate changes could impact mortgages and real estate in 2024. Brett, before we delve into our discussion, could you please share a little bit of your extensive background in the mortgage industry and your role at Guaranteed Rate with us?
So I've been in mortgage banking, as you said, for 21 years. I've been a loan officer and a manager during that time, seeing all of our market ups and downs. Change is difficult for some people, but I think we're getting to a point where it's going to be so much better going forward. Rates are coming down, and that's just going to help.
Thank you very much, Brett. Now let's talk about a hot topic. The Federal Reserve is planning to cut interest rates 6 times in 2024. My first question is, how do you foresee these changes affecting mortgage rates and consequently the affordability of homes?
Well, it's going to have a huge effect. In October, we pretty much hit the high rates that we haven't seen for decades. It's already coming down right now. The Fed had to raise rates to help cool inflation. That affects the bond market negatively, and that's why interest rates went up, because they need to slow down that market. The changes that they have done have done that. We're already seeing inflation come down. We're near 4% right now. Their goal is 2%, but we were at 8 and 9% for a while. So their actions are working. And what that does to the bond market is, as the Fed lowers what they call the overnight rate, and that doesn't tie directly into mortgages, but what it does do is it affects the bond market, and that's where mortgage rates basically come from. So as the Fed puts out what they're going to do, I mean, we never know exactly what's going to happen, but most of the Fed presidents feel that their job they've done is working and has worked, and now they can start lowering their rates, which will drive mortgage bonds up, which is good because that in turn lowers rates for us. So we're going to see some rate decreases coming in. I hope it's 6 next year. We never know. Could be less, could be more, but it's all going to have a positive impact on mortgage rates, which, that spills right over into the real estate market.
Okay, good. All right. As someone who's deeply involved in the mortgage industry, could you shed light on how shifts in interest rates typically influence the decisions of home buyers and those looking to refinance?
Starting with the buy side, we had, record low interest rates for a couple of years, and people got used to that. They got used to 3 and 4%.
Right.
That money wasn't real. That was the Feds doing what they do to help stimulate the economy after COVID. So that's why rates went down. It was purposeful. And we're probably not going to see those ever again unless we have, some major economic impacts from something else. When you look back over the last 55 years, the equilibrium for mortgage rates is 6%. We're getting closer to that right now. So as rates drop down, when people hear, rates are going to be in the 6s or rates are going to be in the 5s, it just crosses that threshold. Just like a retail business may have a product for $2.99. They do that because $2.99 looks a lot better than $3.
Right.
So mortgage rates are kind of the same. People get in their brain, it's in the 5s now. Okay, now I want to move forward on something. Interest rates from a refinance point of view really depends on what their current rate is. Typically, and everybody's situation is different, but typically you want to look at about at least a half of a point drop in their rate. So if somebody's at 6%, it's probably going to need to be at least 5.5 or lower before it makes sense for them.
Mhm.
And we just run those numbers. Okay, this is how much you're going to save per month. What is the cost of doing a refinance? And that tells us what the recoup time is. And people really like to know the recoup time in their savings, because if they're not planning on being in the house 2 years and their recoup time is 3 years, it doesn't make sense to do a refinance. They're not going to earn their money back, so to speak.
Right.
So we always want to go through those numbers just to make sure it works for them. But typically it has to drop at least 0.5% for it to make sense.
We often hear about the importance of a gradual approach to policy changes. From your perspective, how might a measured strategy in interest rate cuts impact the stability and dynamics of the mortgage and real estate markets?
Well, one of the things we have to look at is how does the Fed increase or decrease rates? We basically go in quarter point increments, and very, very rarely does the Fed drop or increase rates more than 0.25%, or 0.5% would be the next one up, because that can be too drastic of a change. So they do like to take a measured approach, as your question asked, that we're better off going slow, because when the Fed changes something, it's a trickle-down effect to us, which is now a trickle-down effect to buyers and consumers, and sellers for that matter too, because if somebody's selling a house, they got to probably rebuy a house somewhere. Right. So it affects everybody, but you don't like to make huge changes to start, just from the fact of that can defeat the purpose of why they were lowering rates or why they were raising rates. So I think you're always going to see a measured approach when it comes to that. And have they made drops or increases more than 0.25%? Yeah, they have, but it's really not every situation warrants that. And that's why typically you see a quarter point movement at a time.
Given the potential economic factors at play, how could these interest rate adjustments serve as a stimulus for the housing market? And on the flip side, are there any potential challenges or concerns?
What a lot of people don't know is an interest rate's going to affect their payment much more than maybe putting another $1,000 down. One of the easiest ways to look at things is, for every $1,000 on a loan, that's about $7 a month in payment. So if somebody wants to put down an extra $10,000, they're going to save $70 a month. Whereas if they have, depending on their loan amount and depending how much rates go down, that's going to have an effect on their payment a lot more than $70. So interest rates control the payment a lot more than the actual down payment or loan amount. And honestly, there are so many options out there for buyers and for sellers right now too. And I think what we're seeing is, because there's not a lot of buyers in our market right now is kind of a great time to buy, because it seems as if we're getting sellers to do seller contributions where they'll help pay for a buy down for somebody's loan. They're allowed to do that. An example is I locked a loan in early this week at 7%. And the sellers were paying for a 3-2-1 buy down, which means in the first year, they're buying that rate down for those buyers to 4%. The second year, it'll be 5%. Third year, it'll be 6%. And the fourth year, it'll be, through the 30th year, will be the 7% note rate. That can have a huge effect on buyers' payments and feeling comfortable getting into the house. And it helps the sellers sell the house. They don't have to do maybe a price reduction. Right. They can just offer that in lieu of a price reduction. And that has seemed to be the path that most deals are going on right now.
Right. And with those buy downs, they can refinance anytime.
They can. And what they have to look at is, and this is something that I'm going to have a conversation with my buyers about, how long do you anticipate staying in the house? Is this a long-term house? And does it make sense? Because we know that in our example, that rate's going to go to 7%, but they are going to have 1 and 2 years at 4 and 5%. That's fantastic. And if rates are above that, we may not want to do a refinance at that time, but maybe in the third year we want to look at doing that, because maybe this is going to be a long-term home for them, and they don't want to pay 6 or 7% if rates are 5.5 at that point. And that's when they would look at doing a refinance.
Right. And then with the interest rates reducing next year, we're probably not going to see these buy downs as much, right?
I wouldn't think so.
Right.
They've kind of come back more in vogue a little bit because it is somewhat of a buyer's market.
Mm,
I don't want to say completely, but somewhat it is, and that's why sellers are doing these offers. But yeah, as rates drop down, that will go away a little bit. Still there, still an option.
right.
But as rates go down, it's going to get back to more of an equilibrium in the
Right.
market. And by that, I mean equal number of sellers and buyers.
Right.
So you won't see those seller concessions as much because of that. So this will go away a little bit. It's still available, though, if people want to do it.
Yeah. In the real estate industry, we've seen prices go up, but not like significantly. Like
No.
you're talking 10 or 20,000, but the buyers generally get that 20 or $10,000 back in some form of a concession, whether
Right.
it's towards their closing costs or whether that's towards their buying points.
Right.
But I'm thinking with the interest rate reductions, we're going to start to see these prices start to go up.
And we could, and kind of where we anticipate the market to go is going to be dependent upon how low interest rates drop. But when interest rates get down in, could be the low sixes, high fives, we're going to see a huge influx of first-time home buyers, and investors are going to get back into the market. So those two groups are going to be a huge amount of buyers coming back into the market. The problem is they're not bringing a house to sell with them. And so now we already, as you know, we have very low inventory. Some price points have less than a month of inventory for buyers to choose from. So in our eyes, what's going to happen is all these new buyers are going to come into the market. They're not bringing a house to sell. So guess what? Now you have a lot more buyers with the same amount of inventory. And I don't think it'll go back to like it was in 2021. Yeah. I don't think it'll go back to that kind of craziness, but you're going to see people that they're going to be competing with other buyers on the same property, and people are going to start offering more than list price to get it. They want that house, and that's what they have to do to beat out the competition. So that's a thing that we are going to see as rates drop. Don't know exactly when that's going to happen, but it also comes back to the point of, I hear all the time, I'm sure, when's the best time to buy? And people, I'm going to wait for rates to drop.
Yeah.
Well, that's great. Rates going to drop. And guess what? You're going to pay probably more for the house because you're waiting for that time for the rates to drop to get there. Then you're competing. And then you've also lost out on 1 year of appreciation maybe because you waited for a year. So we kind of joke, marry the house, date the mortgage.
Right.
And if somebody finds a house they like and it works for them and they want it, get it now, even though interest rates are higher, because I can tell them they're going to be refinancing at some point in time. I don't know exactly how long, but probably within the first 2 years would be our estimation based on where rates are right now. So they end up getting the house that they wanted. They most likely paid a lower price for it versus waiting for rates to get into the fives, as an example. And they're not having to properly compete. There are still some properties that people are competing on. It's just not as widespread as it was before. So, why buy now? Those are the reasons why. You're not going to overpay for the house, and you're going to get that appreciation maybe for the year that you waited. You're going to get that. And we've seen a pretty average 4 to 5% appreciation in the Denver market and the Colorado market. There's areas that are a little bit different, but that's a pretty good average. And when you look over the last 55 years, the appreciation rates are right around 5% a year. That's a very average rate. And that's not really going to change, especially here in Colorado, because we live in one of the best places in the country. Yeah, people want to move here. People are moving here. And, with all that being said, when you have an influx of buyers, value is based on supply and demand. And I have a couple of friends of mine that are appraisers, and they say, house is worth what somebody's willing to pay for it. Right. So if somebody's willing to overpay, that's what it's worth, but they have to, find comparables that match up with that. But we're not going to see prices going down. And I see articles from people all the time that, oh, we're going to have a big bubble. Well, there may be some areas that drop down and some cities. Colorado most likely is not one of them, just because we do already have low inventory. Rates are coming down. More buyers are coming into the market. Supply and demand tells us that's not going to happen. So I think we're going to probably see 4 or 5% appreciation. Buyers need to understand waiting, losing out on that. If you were to buy a house for $500,000 and we had 5% appreciation, that's $25,000 in value in 1 year. And let's say they did wait for rates to come down. So that house is now $525,000, but they're competing and they're going to have to pay $550,000 for it to get it. They just paid $50,000 more than what they would have if they bought now and lost out on the value.
Makes more sense to just buy right now if you love the house.
That's the word right now.
Find the house you love and buy it right now.
Absolutely.
All right. So, I mean, no pressure, but at the same time, the time it takes for interest rate changes to manifest in the market is often discussed. How quickly do you expect these potential rate cuts to translate into noticeable effects within the mortgage and real estate sectors?
It is almost an immediate effect on the bond market, which we talked about earlier. That's how rates get set, is by the bond market. And in fact, typically, if we know the Fed's going to be lowering rates, the bond market will price that in early. And most people don't know that. So by the time the Fed comes out and says, okay, we're cutting our overnight rate a quarter point, that's already been built into our rates. It's already happened. And that's why it's so refreshing to see all of these Fed presidents, regional presidents, most of them are coming out and saying, hey, our job's done. We're going to start cutting rates next year. Well, the bond market has reacted favorably to that already. Right now, we are in the low 7s or high 6s potentially with no points, depending on the loan program and credit and things like that. But it's already lowered because they're anticipating that. And the flip side happens too. If we think the Fed's going to raise interest rates, the bond market will drop and rates will go up even before they announce it. Okay. So the good news is in a declining rate environment that we're in right now, it actually gets priced in before the Feds even do it. So it's another advantage for us.
In the event of a more significant rate cut due to economic challenges, what challenges might arise for both mortgage lenders and individuals in the market for a new home?
It's going to make qualifying much easier, especially if we see big interest rate drops. Mm-hmm. Interest rates, it has a huge effect on the actual payment that borrowers have to qualify for. Mm-hmm. And that's one of the problems, especially first-time home buyers. It can be more difficult for them to get into the market with higher interest rates because the payment is higher. Even if they can afford it or are comfortable with it, they still have to qualify for that. So when rates are going down, it just helps more people to qualify, and they can qualify for more house. I have a client right now that is looking in about $500,000 for the house that they want, and they found one for $575,000, but we are having to wait for rates to come down about another quarter point in order for them to qualify for that. And so it just gives the buyer an opportunity that as rates go down, they're going to qualify for more house, right, just strictly because of that.
Looking forward, how would you advise individuals in the real estate industry, such as home buyers and home sellers, to navigate and prepare for potential changes in interest rates?
I think the biggest thing is talk to a professional, know the market. So talking to you about maybe specific neighborhoods or areas, know the lay of the land, so to speak, and then always get pre-approved before you go look. Yeah. Because nothing's worse than, we're working with a buyer, they find a house they love, and then I say you don't qualify for that house. We don't want to do that. So getting all of your ducks in a row, so to speak, and getting pre-qualified, you're not doing extra work. You're just doing it early. And what we do is I'll collect what documentation I need. I can actually have my underwriter review their documentation. So I know we are in a good position and I know how high we can go in a payment. and then I can extrapolate out from the payment, here's a price range that you're going to be looking at. So that way, when people are going to look at a house, they know they can have it. And if it's at the very top of their budget, I say, give me the address. Let me run the numbers before you go look. So that you know when you walk through that door, I can get you qualified for this house at that price. And I cannot stress how important that is. Some people are nervous about doing that. Some people don't want their credit pulled. So one of the advantages that we offer is we can do what's called a soft pull to start with. It doesn't hit their credit at all. But if we do a hard pull, because we do what's called a mortgage tri-merge, the Super Bowl of credit reports, and that's why mortgages use them. But the bureaus, they understand somebody's looking for a house. They only hit them 1 point. So it's not a big hit like if they had gone to Best Buy and had Best Buy pull their credit and get one of their credit cards. Yeah, that's going to be more of a ding on your credit. So on the mortgage side, they don't need to worry about that, but we actually have a way where we can do the soft pull as well. Once they go under contract, then we have to do a hard pull and verify all that. But it just gives buyers the comfort of knowing, hey, what I'm going to look at, I can afford. I know approximately what that payment's going to be, and I know I'm going to qualify for it. Those are the two biggest things that people really need to do, is work with professionals that know the market and can help walk them through the scenarios. A lot of people have Uncle Bob that bought a house 10 years ago, so he knows that Uncle Bob told me this. It's like, well, that's just not accurate. So that's why talking to a professional, knowing exactly where you stand, doing all those things up front, rather than when you do go under contract on a house, we got a lot done up front. Plus, it makes it great. Let's say a buyer got fully pre-approved, underwriting signed off on everything. They're competing with somebody else in the house. I can call the listing agent and go, yes, this buyer's very well qualified. In fact, we've already been through underwriting and have an approval. That is gold to a seller.
Oh, of course.
So if two people are competing and one's pre-approved with me and the other one hasn't even talked to a lender yet, that seller, I can pretty much tell you what way they're going to go.
I couldn't agree with you more. Having the buyers get pre-approved before they start house hunting is a real critical step in the whole home buying process. I mean, and it does make you stand out. When us selling agents, or when a selling agent reaches out to the buyer's agent's lender to verify that this person has been pre-approved, or they do have a pre-approval letter, that's going to make you stand out more than all the other buyers who are especially not pre-approved or are just pre-qualified.
Well, and I'll be honest, virtually every agent that I work with, they won't even show properties until they've been at least pre-qualified.
I mean, you don't want to waste your time, your agent's time, the lender's time. You don't want to waste anybody's time.
And the seller's time, too.
And the seller's time.
They may have kids,
Yeah.
dogs that
They
they
have
need
to
to
leave
get out
the
of the
house.
There you go. Exactly. So, it's a courtesy to do it, but really for the buyer, it gives them the security and knowledge of what they're doing and what they can do and what they can look at.
Especially if it's not going to be affecting their credit score.
Exactly. Most people think, I can't tell you how many times, I don't want to do an application because you're going to hit my credit.
Right.
And so I explained to them the situation, and they're like, oh, I didn't know that. And
Right.
it's most people don't know that.
Right.
They just think having your credit pulled is a hit. And the other thing is, okay, let's say some people have some issues on their credit. I can also help walk them through steps to help improve their credit. So they may not be ready to buy right now, but in 6 months they will be, because the steps I can give to them, and I have a program where I can plug in their credit report and literally say, okay, if we pay off this card, what do we anticipate their credit score? And it'll give us a range on where it thinks the credit score will go to. It's not perfect, but it gives us an idea. And that way I can pass along that information to these buyers saying, okay, hey, we're not doing something right now, but let's get this fixed so that in 6 months we're ready to go and you do qualify. Plus, the other reason is you always want to have the highest credit score you can. strictly from the fact that credit scores affect interest rates. Somebody has a 780 credit score versus somebody has a 640. That could be a 0.5%, 0.75% difference on the rate. Exact same program, exact same price, everything else is the same, but that credit score affects it that much. Yep. It's amazing what doing one thing on your credit report can do. And as an example, I had a client 2 months ago. He had a judgment that he was unaware of, and it was for $150, and he had a 580 credit score. He went and got the information, and it was legitimate. He paid it and got it cleared, and I can clear it off a credit report if I get the right information, and I can do what's called a rapid rescore. And I got the information that it was paid, it was closed, everything's done. We send that into the bureaus, and we do a rapid rescore, and I'll get a new score on them within a day. Wow. And his score, just doing $150, $180 payoff, his score went from 580 to 640 overnight.
Just from 150, 180.
Just that little thing of doing that, because judgments, collections, late payments. Another thing people aren't really aware of is you don't want to pay off accounts or close accounts necessarily, because closing an account can actually have a negative effect on your score for about 30 days. So basically, my clients don't do anything. Don't have other people pull your credit. Don't go close out accounts. Maybe pay down a couple of accounts, and I can tell them how to do that. And don't go out and buy anything. People have bought cars right before closing.
And then
you can't do that.
Falls out.
So, I can give a lot of advice on what a client can do to really help position themselves, even if it's not right now and down the road. They're going to come back to us because we've helped them, even though they didn't buy a house right away. We're here for the long term. Client for life is kind of how we put it. But helping those people achieve their dream that they didn't think they were going to be able to do, that right there that's golden for me. That's why I do this job.
All right, last question. Based on your experience, are there any trends or shifts you anticipate in the mortgage and real estate landscape, given the potential adjustments in interest rates?
Kind of goes back to what we were talking about earlier of why buy now. As the interest rates drop, more people are going to come into the buying market.
Oh, they're going to all fly in.
It's gonna happen. We know it's going to happen. We don't know the amounts because we don't know when those rates are going to actually be dropped. But as those buyers come into the market, we're going to see that shift in your part, where negotiation is going to come into play, probably quite a bit more. So having an experienced agent as yourself, knowing that market and knowing how to deal with other agents, that's going to help the clients, first of all. Knowing what they qualify and all those things that go along with it, being all done with that, is going to help them be prepared, because people are going to be competing for properties again coming up. Probably next year is most likely, but knowing that up front, that's going to happen, and taking care of business up front and getting pre-approved and knowing what they need to know, is just going to put them in a better position if they are competing to win the house, so to speak, and get under contract. So the trends are going to be, as rates go down, more buyers are going to come into the market. That's pretty much what's going to happen. The severity of it, that's what we don't know at this time. But as rates go down, it's more buyers are going to come in, and you need to be, if you're a buyer now, you need to be prepared for that you probably are going to be competing, or you might have to overpay above list price in order to get it. And having a good agent is going to help with that, and knowing that you're pre-approved is also going to help with that, because the seller is going to be much more willing to work with you versus somebody that hasn't done anything yet, or it's just kind of looking, or hasn't talked to a lender yet. They're not going to be taken seriously. And I think that is a trend that we've always preached. Get all this stuff done up front so you're a qualified buyer.
Yeah, get your ducks in a row.
Absolutely.
And buy the house you love. today. So thank you very much, Brett, for your very valuable insights on the potential interest rate cuts and their implications for the mortgage industry. It's been a real pleasure having you on the Living in the 5280 show.
I thank you. I appreciate it. That was great. And I hope this is good information for your clients and provides value to them. That's what we want to do, is provide that value.
Absolutely. And to our audience, thank you very much for tuning in to Living in the 5280. Please stay tuned for more engaging discussions on the latest trends and developments in real estate. And of course, if you have any real estate questions, feel free to reach out to me anytime. And for any mortgage or lending questions, please reach out to Brett DeWitt. Until next time, we'll see you on the next episode.